Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, and here's what's coming on today's programme. Stocks and futures are mixed as traders weigh Jerome Powell's softer tone on rates and weaker inflation readings coming out of China. Credit Suisse delays publishing its annual report and compensation details for 2022 after last-minute queries from the SEC. Plus, Paris in the spotlight after Brexit. Our exclusive interview with the Bank of America Chairman and CEO Brian Moynihan. That is live from the Lenders Global Investor Summit in the French capital. Francine Lacqua bringing us that exclusive, of course, in the next 30 minutes or so. Let's check in on these markets. Yes, Jay Powell moderating his tone when it comes to that decision around March the 22nd, saying a decision has not been made. They need to see the data. But still, 50 basis points is still in the cards for many investors. The market's expecting at least 40 basis points in terms of that decision coming through March the 22nd. Of course, the jobs numbers, the JOLTS data coming through very hot again yesterday. The job openings just underscoring the challenge around the red-hot labour market for the Federal Reserve. The linkages as well for them between the jobs market and the services sector and inflation there. How to get that down remains a conundrum. Of course, here in Europe, we continue to weigh up the commentary from a very divided ECB as well. And you heard from the Italian central bank governor there, pushing back really on the hawks and saying that we really need to be data dependent. Across these European markets, then, a drop of 0.4%. It is worth flagging the data that came out of China in terms of inflation, because the inflation impulse is coming soft. So that idea, that fear that maybe a reopened China will lead to an accelerated inflation picture globally is not coming to pass, at least for now. So possibly that's a silver lining. Futures in the US pointing lower by 0.2% after some very modest gains on Wall Street yesterday. The Japanese yen is lower by 0.7%, 136. Of course, the central bank governor of Japan, Mr. Kuroda, will be wrapping up his final meeting as head of the Bank of Japan. Will there be any surprises in store? We continue to watch that story for you. Bitcoin 21,680, down 1.5%. Silvergate, the bank over in California, very exposed to all things crypto, is liquidating, of course, as a result of the fallout from FTX. Now, we got a somewhat different tone, of course, from the Fed Chair Jerome Powell, as I mentioned, on his second day of testimony to Congress. Powell saying his team will wait for fresh data before deciding how much to hike rates this month.
We have not made any decision about the March meeting. We're not going to do that until we see the additional data. The larger point, though, is that we're not on a preset path and that we will be guided by the incoming data and the evolving outlook. No decision has been made on this, but if the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
Okay, for the analysis, let's bring in Bloomberg's Justina Lee. Justina, help us make sense of what's happened over the last 48 hours in D.C. from Fed Chair Jay Powell. Hawkish, very hawkish, surprisingly hawkish. And then he comes out and moderates that message. Did he regret the comments around 50 basis points, around moving higher in March? What is the view? What is the commentary? What is he trying to message to markets and the wider public?
I think ultimately what he was trying to say is that the Fed is still data dependent. But if you look at the totality of his comments, I mean, the takeaway is still hawkish. It's still the fact that the Fed is very determined to curb inflation. And they're not just looking for hints that inflation has started to slow. They're looking for a trend there. And I think that's why the data that has come out in the past few sessions haven't been exactly encouraging. I mean, job openings did drop a little bit, but it's still historically elevated. And all eyes are now on payrolls this Friday and CPI next week.
Non-farm payrolls, as you say, on Friday, really, really central to how we form our views about the Fed. In terms of the market impact, yields coming off very modestly today, about 2-3 basis points at the front end, the 2-year still holding above that 5% level. The implications across these markets, are the markets adjusting well to this commentary from Fed Jay Powell? The shock factor around 50 basis points, if that's what happens come March the 22nd, how much volatility could that inject into these markets?
Yeah, I think it's probably helpful to note that markets have already repriced their expectations of the peak Fed funds rate this year earlier last month. But we did see a little bit more repricing recently, because earlier markets were solidly expecting 25 basis points for this March meeting, but now it's closer to 50. And so I think that, it's still going to take some time to digest, and we could see more volatility. Okay, more volatility potentially in the cards. Thank you very much indeed, Bloomberg's Justina Lee, of course, on the comments from Jay Powell there.
of course, giving his second day of testimony and softening the tone a little bit when it comes to the 50 basis point conversation and just how far they go. Of course, the market's now pricing in about 5.7% in terms of the terminal rate from the Federal Reserve. Let's get to a big corporate story, the corporate story of the moment, back in focus for us again today. Credit Suisse is trading lower this morning after the bank says there will be a delay in the publication of its 2022 annual report. This comes after the SEC raised a last-minute query on previous statements. Joining us now is Michael Moore, Bloomberg Finance editor. Michael, let's start with a question around Credit Suisse. It's not every day that the SEC picks up the phone to you on a Wednesday evening and says, hang on, we want to check 2019, 2020 results, or at least cash flow statements. How serious potentially is this for Credit Suisse?
You know, it's a little hard to tell at the moment. It's odd to delay an annual report over these previous questions, whether that's, you know, the bank being rightfully cautious. You know, often the U.S. banks don't set a specific date for their annual reports, so there may be situations where they have to wait a minute and we don't know about it. But it's not the best look for them given all the trouble they've had. It's a little unclear how serious this could be. Like I said, are they being cautious, or is this a major question given that it impacts 2019 and 2020 restatements and not the 2022 results? That may give investors some comfort, but the stock is down. And it's one more thing that investors are having to grapple with.
So at this point, if they were to get just a month behind them of no bad news, that would be an achievement for Credit Suisse. So far, they're not able to do that. Down 3.7%, as you say, the stock on the back of that news. Meanwhile, this is a very, very serious story unfolding. Of course, the controversy, the scandal, the litigation involving JP Morgan suing its former executive, Jez Staley, for Epstein dealings. What do we know?
So JP Morgan has been sued by Jane Doe, an alleged victim, and by the U.S. Virgin Islands over its role in having Epstein as a client. JP Morgan has now turned and said, if there is any issue here, it's just Staley's issue because he was the executive in charge of this relationship. It's certainly a dramatic move for JP Morgan to go from saying there's nothing here to blaming Staley. Staley has consistently denied any knowledge of Epstein's criminal dealings beyond what was publicly known. But it's certainly raises a lot of questions for Staley himself. It raises questions for Barclays, which, he was running up until 18 months ago, and which there's still some outstanding awards and pay that Barclays may or may not have to pay to Staley. JP Morgan is going after Staley for the pay he made during his time there. So this is, a pretty dramatic development in what has been a long-running saga.
And looking to squeeze about 8 years of back pay from Staley as well, JP Morgan. A really, really important story that you and the team will be across for us. Thank you for the latest on that. JP Morgan, of course, and the lawsuit against Jez Staley, former CEO of Barclays and, of course, head of wealth, formerly at JP Morgan. Thank you, Michael Moore. Now, coming up, we are going to speak with former Croatian President Kolinda Grabar-Kitarović. It is the first of two exclusive interviews this hour, live from Bank of America's Global Investor Summit in Paris. And later in the show, we're going to sit down with Bank of America Chairman and CEO Brian Moynihan. Do not miss that interview. This is Bloomberg Economics, Finance, Politics, of course. Stay with us. Economics, Finance, Politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, Bank of America is hosting its first Global Investor Summit in Paris as the French capital's finance profile rises. Let's cross over then to Bloomberg's Francine Lacqua, who is at the summit along with a guest. Francine.
Thank you so much, Tom. Yes, we're here at the Bank of America Global Summit, their first, actually, and we've been speaking to the Apollo chief executive. We've also been speaking to senior management at Bank of America. And now we want to focus a little bit on politics. So I am delighted to be joined by Kolinda Grabar-Kitarovic, the former president of Croatia. Thank you so much, Madam President, for joining us. Here in Paris, a lot of the configuration in terms of peace in Europe depends on what happens in Ukraine. Some say this will be protracted. Some say, look, we could see a resolution sooner. How do you see this ending?
Well, it's impossible to predict what the ending will be, but we're in for a long haul, certainly. It depends on what will happen on the battlefield. We're currently at a relative stalemate where we have a grinding war of attrition, where Russia is slowly gaining a little bit of ground, but Ukrainians are putting up really strong defense. And both sides are looking for a breakthrough. Now, with the current situation, for Ukrainians to be able to make much progress, they would need really an increase, quite an increase in the quality and quantity of weapons. And for Russia, President Putin more or less announced in his State of the Union speech for the Russian audiences, for the Russian public to prepare for a long war. And that long war works in his favor because what he's doing right now is consolidating the defenses in the occupied areas and preparing for a new offensive. Of course, for Ukraine, it's of utmost importance to liberate and reintegrate the occupied territories. It's an issue of state sovereignty and territorial integrity. And respecting Ukraine's right to self-defense based on the UN Charter.
I mean, there's now talk from the Western allies of sending planes. Does that make a material difference on the battleground?
Well, right now, what would make a material difference is actually shifting that war from that grinding artillery attacks, yes, where so much ammunition are being spent, and Russia has turned to a war economy where basically 24/7 they produce missiles and shells to pound Ukrainian infrastructure, including energy and civilian infrastructure. And what Ukraine needs is ammunition. It needs tanks, but also needs training to shift from that artillery warfare, to shift from what we currently have, a combination of World War I trench warfare and tank battles from World War II, to more sophisticated types of warfare where quality really dominates over the quantity.
I mean, is this the Russia war on Ukraine, or is this almost also a proxy war between the West and the East to kind of, take two of what's China's role in this then?
This isn't a proxy war, not at all. What NATO and the West, I don't like to actually call our countries the West.
How would you call them?
I would call them an alliance of liberal democracies who support Ukraine and Ukraine's right to self-defense and the principles of international law and order and the UN Charter, so state sovereignty, territorial integrity, and the right of every nation to choose their own future. Now, China, obviously, is becoming a global player, and they want to profile that position a lot further. They recently proposed that 12-point peace plan for Ukraine, which is not actually a peace plan. Even Minsk and Minsk II were a lot more detailed than that. It's more of a geopolitical statement where you see support for Russia. That is political, that is ideological.
And that will stay?
That, I believe, will stay, although Russia and China have had their historical grievances. But in today's world of geopolitical shifts, that alignment between Russia and China is important to Russia and China. It's important for China that Russia not be humiliated. But I think that what goes in favor of China is also the fact that Russia, with this war, has become a junior partner to China. They have literally descended from the Championships League to Juniors League with respect to China and the global position of Russia overall.
Is there any way of changing China's position in this? And if there is, would the war get de-escalated quite quickly? And who would be able to convince China to think otherwise?
The war could end right now if Russia stopped attacking Ukraine and pulled their forces out, because this is an aggression against Ukraine. The war is being fought on Ukrainian soil, and Ukraine is defending themselves. There are some positive aspects that China really supports the principles of state sovereignty and territorial integrity. And even Russia recognized Ukraine within internationally recognized borders, including Crimea. However, there are also some concerning factors, as stating that when considering one's security, one should consider other security as well, hinting at the fact that Ukraine or some nations shouldn't have that right to choose their own alliances and their future.
But, Madam President, I mean, the fact that Vladimir Putin would now say, actually, no, this was a mistake, I stop, is what, at 0%. What is the chance of China saying, look, Vladimir Putin, this is a mistake, you have to scale it down because we will no longer support you?
I don't think that they would ever say that publicly. I am sure that they are putting pressure on Russia to de-escalate in a certain way. I'm convinced that, first of all, with respect to nuclear rhetoric that we heard a lot about towards the end of last summer and the beginning of September, that China has put pressure on Russia in order for Russia not to talk about nuclear solutions, because the nuclear war cannot be won and should never be fought. I think that China actually has put pressure on Russia to protect more civilian populations and POWs. However, what is concerning is that continued economic support, which is feeding Russia's war machine, like buying oil, albeit at a discounted price, but standing by Russia in this quest and asking for a ceasefire without actually asking for Russia to pull out of Ukraine.
Do you think Ukraine should be part of NATO?
NATO's door remains open. It is up to NATO and for prospective countries to decide on their own future. The focus right now is on assisting Ukraine to defend themselves and to provide the proper resources, because in order to keep peace in Europe, we do need Ukraine to remain a sovereign and independent state.
You are one of the names as possible candidate to replace the Secretary General of NATO. Do you think NATO would be ready to be led by a woman?
Well, these are not the times to express any personal preferences. I think these are crucial times for collective interests of self-defense in Europe, and I believe that whoever becomes the future NATO Secretary General has to have at least three crucial capabilities. One is to be able to work across belligerent lines and divisions across aisles. The second one is to be able to deal with the post-war situation in Europe, where we will still have Russia's attempts at aggression and expansionism as challenges to European and global security. And the third crucial aspect is really to be able to deal with or to work with NATO allies and partners in order to de-escalate and diffuse tensions and situations of potential escalation wherever possible with Russia.
President Kitarovic, thank you so much for joining us. That was, of course, the former president of Croatia. Tom, with that, I'm going to send it back to you in London. And then coming up, we'll have plenty more from the conference. We'll also speak to the chief executive of Bank of America shortly.
Francine, thank you very much indeed. And of course, Francine Lacqua is at the Bank of America Global Investment Summit in Paris, and we'll bring you that exclusive interview, of course, with the CEO and chairman of Bank of America in the coming minutes. Coming up, tens of thousands protest across Israel over plans to cut the power of the Supreme Court. We bring you the latest from Tel Aviv next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, tens of thousands of people are protesting across Israel over plans to cut the power of the Supreme Court. The Israeli Defense Ministry says US Defense Secretary Lloyd Austin has moved his bilateral meeting to the airport in Tel Aviv due to those disruptions. Let's bring in Bloomberg's senior editor in Tel Aviv, Ethan Bronner. Ethan, just get us up to speed on what is happening on the ground and but the potential impact for markets.
Well, potential impact for markets is being felt, I think. Basically, we've had for 9 or almost 10 weeks in a row an extraordinary number of Israelis out on the streets, sometimes hundreds of thousands. Today, it's the beginning of the day here, but we've got tens of thousands in about 20 different places, including at the airport, where the Prime Minister is hoping to go to Rome. So basically, the problem is that people are afraid that if the court's power, the Supreme Court's power, is reduced, that will, in fact, turn the legislature and the executive able to do whatever it wants, and the checks and balances needed for a proper democratic country will fall away, and that the kinds of investments that have really driven this country to incredible wealth over the last 10 or 15 years will disappear. There is already talk of several billion dollars, perhaps, that may or may not be leaving or have not coming. And so, in addition to that, we have military reservists saying that they don't want to serve if this change goes through. The military reservists typically are also the people who run the business in this country. They've often, the high-tech in this country has been extraordinary, and they got their start in the high-tech part of the military. So it's all rather linked, and it's something of a culture war between popular, religious part of the country and the more secular, well-off part of the country.
Okay, Ethan Bronner in Tel Aviv on a really important story, the implications for the democracy of Israel and, of course, investors with exposure to that economy. Let's briefly check in on what's happening with Credit Suisse in particular. That stock down now by 4.6% after it delays its annual report after a query by the Securities Exchange Commission. Down 4.6%. Dassault Aviation, note, storming up 10% on the back of better earnings. Come up, we're going to speak to the CEO of Bank of America. Stay with us. This is Bloomberg. Good morning and welcome to Bloomberg UK. I'm Tom Mackenzie in London. On the show this week, Paris in the spotlight after Brexit, our exclusive interview with the Bank of America chairman and CEO Brian Moynihan, live from the lender's Global Investor Summit in the French capital. Also on the programme, flickers of life appear to be returning to the UK housing market. We'll discuss the latest survey from the Royal Institution of Chartered Surveyors. Plus, our interview with dovish policymaker at the Bank of England, Swati Dhingra, who says more rate rises could damage a weak UK economy. Let's return then to a story we've been covering this morning. Bank of America is hosting its first Global Investor Summit in Paris. The French capital's finance sector has seen huge growth in recent years following the UK's exit from the European Union. Let's get to Bloomberg's Francine Lacqua, who is at the summit along with a guest. Francine.
Tom, thank you so much. We've had some great guests so far. We spoke to the Apollo Chief Executive Officer. We spoke about NATO and Ukraine with the former Croatian president. And now we're joined really by our host today. He's Brian Moynihan, and he's the Chief Executive Officer of Bank of America. Brian, first of all, thank you so much. You're putting on a great conference. And you're here in Paris because you were really one of the first Wall Street banks to say, look, in this Brexit world, this post-Brexit world, I want to choose Paris. Is this being vindicated?
I'm not sure what vindication would be. So post-Brexit, we looked around, and this was a place that we put our broker-dealer, our securities operations for Europe. And we've gone up 10 times the number of people we had in 2019, and that's a relatively short time frame. And we're very happy here. It works well. Vanessa Holtz and the team run it under Bernie Mensah's leadership, and they do a great job. And more importantly, thank you for joining us today. It's a great conference, and we're glad to have you here to help us spread the word and get the ideas that come out of it out to the market. So
in this post-Brexit world, how do you see actually servicing your clients in Europe, and how do you see the animosity that maybe the two sides are getting closer in these Brexit negotiations?
Well, the Brexit negotiations are going to have a lot more to do than financial services, but our strategy from the beginning was to get operational, get our clients used to the fact that they're going to, what they call face off in the markets against different entities, get those entities stood up and put together. So we have a UK broker-dealer, and our bank is branched in the UK, and then we have our Ireland subsidiary and the French subsidiary, a bank and a broker-dealer. So you had to get ready to go. And so it'll work out over time, and we've been around for 200 plus years, so whatever rules, as long as they settle in, we can operate. But it was disruptive at the time, and it's going to have implications to how capital raising works in a market that wasn't completely unified yet. Even the promise of the Europe to get to combined capital markets and the uniform capital markets was still in front of us, and now you split two major pieces. So we feel good about what we've done. It would have been easier if we didn't have to do it, but that's not our choice, and now we continue to adjust.
Right now, how many times a day do you get asked about U.S. inflation and the Fed?
Probably more than we should, because the U.S. has this big, huge economy of which goes and moves along. And so, if you think about our team at Bank of America's research team, which is one of the best in the world, if not the best in the world, under Candace Browning-Platt and her leadership team, they basically have a recession predicted beginning in the third quarter this year, third, fourth, and first quarter. But it's a slight recession. It goes down 1% or 2% and then moves back up, and then gets back to 1.5% growth in the latter part of next year, but still below trend growth. And so the Fed has to cut off the inflation, and they're clear about that. And you had Chair Powell testify for 2 days, so I'm not going to illuminate anything.
And the markets were all over the place on the back of that.
It will be, because they're all trying to figure out. But remember, the big move was 0 to where we are now.
Yeah.
We have 75 basis points more to 5.25, 5.5. But the big move is where we are now, and that is still soaking through the economy. So the most interest rate sensitive pieces of the economy impacted quickly. Housing, mortgage originations for banks down, other types of financing down. The capital markets adjusting caused the leverage finance and capital markets to close, and now they're opening back up, and that's good, but you're getting some stability. But that's the intended outcome: sucking liquidity out of the system, bank deposits going down, especially after the massive stimulus. That's what they're intending to do, and it's happening. Now the question is, how long do you have to wait against a good consumer and employment and things like that?
But are you surprised at how resilient the U.S. economy was? And I remember, 7-8 months ago, a lot of the chief executives, also of Wall Street banks, saying, look, there's going to be a tornado. It's going to be a really tough, economy for the consumer. And actually, we have not seen them. Were they wrong, or is it just going to be delayed?
Well, it's going to be delayed. It has been delayed, so that's a fact. But the question is, if you look at the American consumer in February, so we track all the consumers and how they spend money, and that's $4 trillion plus a year. So it's not a small sample. And if you look at what happened in February, it increased over January's rate of year-over-year growth. It's now, for year to date, it's up to about 8.5%. February is higher than that, or up to 8%. February is about 8.5% to 9%. That means the consumer's accelerating again. And so the first thing is the consumer spending across all dimensions. Now, they've moved to services away from goods. The travel experiences, luxury hotel bookings are up a little bit more than regular hotel bookings. You can see all the activities. If you go to the other side of the track, do they have money in their accounts? If you look, high-end consumers, businesses move their money into the direct holding of securities, the wealth management customers, because that's what they do. But if you look at the mass, the general consumers we have, their account balances are still elevated multiples where they were pre-pandemic. And the spending them down, which is a big worry, they're going down. In fact, in February, they rose a little bit over January. There's always some seasonality.
You're confident. Actually, the numbers you're looking at
they're
are
in good
strong.
shape. Yeah, they're in good shape. Now, that makes the Fed's job tougher, and that's the dialogue you have about how you can slow it down. But it all comes back to unemployment. Unemployment's low. Wage increases are still pretty strong. And you don't see that. New claims for unemployment, we'll see what happens this week. But, each week it's hovering at a level. It's very low, and there's some seasonality debate, but it's still very low if you thought you were really in a recessionary environment.
And what's the market reaction function been like?
Well, it's been, when rates went up, obviously the adjustment and the marks, and last year was not a good year for equities or fixed income, which is very unusual. But if you think about it, the markets then have settled in, and you start to see a little bit of life in the capital markets. The pipelines are full. You saw some deals get through, and that's good news. And yet it's still not close to where it was when it was due, when it was in like 21 and early 22. But on the other hand, it's stabilizing. And so, yes, there's trading volatility every day, and yes, everything moves around. But the reality is a long-term thing is settling into place that says the Fed's, it has to move rates up and has to keep them there longer. That's the piece I think Chair Powell's been trying to make people here over the last 6 months have been, we're going to have to hold them there longer to ensure that we've done the job, even if they don't go as high as people think or a little bit higher than people think. They got to hold them there longer.
Because do markets understand that? And actually, if you see yield back in fixed income, how does that change the whole asset class?
What's interesting, our economists have a rate decrease in March of next year, 24. Interesting enough, people forget that in 19 the Fed cut rates. This Fed cut rates when the economy was slowing down. So the question of when they come down the other side is interesting. But our economists, who are a very talented group, believe that they cut rates because they basically will have won the war on inflation, and then they'll bring it down. Because it's an inverted rate curve is not the normal experience, and they want to get to a real rate curve, but not necessarily an inverted one.
You're one of the only Wall Street banks not cutting jobs. Why?
Well, we have a phrase that we've used for many, many years, let attrition be our friend. And so with a 200,000 plus people, you have a normal turnover rate. It's starting to go down to an all-time low again. So we're we're running about 12% across the whole base. Going in the pandemic, dropped to 6%, worked its way back up, and now it's back down in the mid-single digit, which is terrific. A great place for teammates to work, doing a great job. The reality is you can manage that head count. And so we'll redeploy people across the franchise, including investment bankers, to other parts of the franchise to help us in the middle market investment banking. So you can move it. Our head count peaked in January. It's down a few thousand. It can move, but you had to stop hiring, and that's what we had to do last fall.
What do you spend most of your time on? Is it a strategy in China? Is it, I don't know if it's fintech or ChatGPT.
Well, I spend all my time asking questions about all that because, I've got these talented teammates that drive the company. So, all the issues at the moment, how ChatGPT will affect. We have this thing called Erica, which is a virtual artificial intelligence, virtual assistant, natural language processing, predictive technology that we've been running for 4 or 5 years, and 18 million customers use it. 145, 150 million times a quarter. So we're used to it. But this is now a new one that could change the game. And so we're trying to figure.
Do you think it will? I mean, at the moment, you're not allowing it, are you?
Well,
are you using ChatGPT?
We aren't allowing it. That's more of a technical sort of security question and how it works and things. The use of artificial intelligence and predictive technologies we use not only on the consumer side, but we use that same technology internally. But it runs on our data in an environment we can understand. It doesn't have the exfiltration problem and stuff like that. So it's a great thing. That'll all work out over time. There'll be licenses and brought internal and work on your own data and then bring data into your things. And that's just working through the security things. That's the issue of letting a bunch of teammates go out in the public environment, start potentially pulling our data into the public environment without them understanding it.
All right, but so it will morph into some form that you'll be using basically internal in some way.
Some form of these. We already use it. That's what I'm saying. Artificial intelligence, we went to Stanford to say, give us a natural language processor for financial services. We built the artificial intelligence, worked on the data. We have the insights from the customers. You think about it. You could be driving down a road in a car at 60 miles an hour and talk to our mobile app, and it could go to 110 systems and find a specific transaction and tell you what it was. That's pretty amazing, but it takes the technology, the pipes to distribute, the data array and accurate, and it's pretty wild. But that's still out in front of us.
Also sounds pretty stressful if you're on the wrong side of the trade. Talk to me about China. What's your reopening strategy, or what's your strategy in China given their reopening?
Well, across the world, we basically do two businesses: corporate investment banking, large companies, and capital markets. And Hong Kong is a major place for us, and we have in China itself. And we're continuing to support the companies that both multinationals doing business in China and very large Chinese companies. That's the business strategy we have. We haven't changed that. The atmosphere around it is obviously completely different than what it had been 5 years ago, but and that's something you deal with in the ebbs and flows of the world. But right now, it's just keep your risk where you want it, keep your operations in good shape, and make sure you understand what's going on.
But how do you look at the regulatory questions, or actually what China wants to do with financial services?
There's a lot of negotiations that are going to go on between our two countries over time here, and just like Brexit, when a set of rules become understood, we can do it. Right now, there's a set of rules that we operate within, and it's fine. But you wish it wasn't as difficult in some of these countries because of the geopolitics, but that's the reality of being in a business which basically works to reflect the economies of the countries around the world and helps clients prosper in them. And that's the nature of it. So we're there, but on the other hand, it's a little trickier being there than it was 5 or 6 years ago just because of the environment.
What are you most hopeful about in the next 12 months? I mean, we talk about the Inflation Reduction Act. I mean, there's so much actually going on news-wise. What do you see as a positive?
I think what I'm hopeful about is when you see all these companies that we work with, whether it's Sustainable Markets Initiative under King Charles' leadership, or whether it's the work we do at the World Economic Forum, or whether it's the work we do in the Business Roundtable in the U.S., or you see all these companies who understand fully that they've got to deliver for society and deliver for the shareholder in driving the changes, whether it's on the environment or other issues, and doing it from a fundamentalistic capitalistic basis, that the capital can be redeployed. And charity doesn't earn a return. It's psychographic and impact, but the reality is, once you give away the money,
this is real
capitalism has to solve it. And so we did, in the sustainable finance area generally, we've done $430 billion in a couple of years. Our 10-year program for $1.5 trillion. We're averaging 200+ billion a year. Environments, 230 of that. And our customers are making the change. Each day I get up and I get a feed of stories and stuff all about all the deals that went on in the environment space. It's amazing what's going on, driven by the private sector. And that's what gives me huge confidence not only in the next 12 months beyond, as the private sector is leading this, which means that stick to the ribs quality.
Brian Moynihan, thank you so much for joining us today. And thank you again for a conference. We'll have plenty more, of course, from the conference. We also have a former French president coming up, Tom, so we'll bring you that interview shortly. And this is Bloomberg.
Okay, Bloomberg's Francine Lacqua, of course, at the Bank of America Global Investor Summit in Paris. Now, still ahead from that summit, an exclusive interview with the former US House of Representatives Speaker Paul Ryan. That's at 10:30 a.m. London time, 5:30 a.m. if you're in New York. Coming up, UK property surveyors say flickers of life are returning to the UK housing market. We get the details. This is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Tom Mackenzie in London. Now, the UK property surveyors say there are now flickers of life in the housing market as both buyers and sellers return to the market in February. The Royal Institution of Chartered Surveyors, RICS, says prices fell again, but its more forward-looking survey pointed to signs of improvement. Let's bring in Tarrant Parsons then, senior economist at the Royal Institution of Chartered Surveyors. Tarrant, thank you and good morning. Thank you for joining us this morning. Where is the relative resilience then in an environment, of course, of houses and households under pressure, the cost of living crisis, higher mortgage rates, but there seems to be, and this is what the survey points out, relative resilience within the UK housing market. What are the supporting factors?
Yeah, I would kind of caveat that with saying trends across the UK housing market are still quite downbeat in terms of the overall picture being reported for activity. But just last month, we saw our indicators on buyer demand and sales volumes, albeit they're still weak. They did move off of the lows that were seen right at the end of the last year. What I think has happened is we saw a very sharp adjustment following the spike in mortgage rates in October. Financial markets have settled somewhat since then, and mortgage rates have come back slightly. They're still much higher than 12 months ago, but the real drop off in activity came at the end of last year. Still weak now, but recovering maybe slightly.
So where does that leave the RICS view on house prices if you look out a further 6 to 12 months? How much more downside is there across the pricing of housing?
Well, looking at our data and its kind of track record for leading upcoming changes in the official house price index, I think a reasonable projection at this stage would be to say that prices could be down by somewhere in the region of 10% year on year. That's at the national level in 6 months' time. I think the fact that our price indicator didn't really sink any deeper into negative territory this month may even suggest that the decline might not be quite as steep as that. But then again, I think the situation is very fluid. It's very difficult to give a precise forecast when there's so much uncertainty around the outlook for the economy and for interest rates. So that 10% fall seems a sensible estimate at this stage for me.
OK, 10% year on year as the fall for house prices. Before we let you go, Tarrant, a view then from what to expect from the budget. It is, of course, next week, March the 15th. What do you and the team at RICS want to see from this government to support the housing sector?
Any support for kind of house building or retrofitting is always going to be welcome. I know house prices are falling right now, but there is a real, that's because of the mortgage rate increase, there's a real kind of supply shortfall, especially if you look at the rental market. So tenant demand is still very strong. That's pushing rents higher, and both, home ownership is very costly. Rental prices are very costly as well and rising sharply still. So delivering more units is going to be critical if you really want to make the UK housing market more accessible longer term.
OK, Tarrant Parsons, senior economist at the Royal Institution of Chartered Surveyors. RICS, thank you very much indeed in what is needed from that budget that, of course, is coming up next week and the state of the UK housing market. Now, coming up, the BOE, the Bank of England in the balance. We dissect some of the diverging views, and they are diverging, from the rate setting committee this week. That is next. This is Bloomberg.
was right, but I was also basing my views on the research that indicated that front-loaded policy would be a superior strategy to achieve the equilibrium. But on the other hand, we have to remember just how strong the external forces of inflation are or have been. And so, although I'm vindicated, I also recognize that the external forces were going to be there anyway.
OK, the Bank of England's Catherine Mann there speaking to Francine earlier this week about the need for tighter monetary policy. After these hawkish comments, the BOE's more dovish MPC member, Swati Dhingra, has warned against further interest rate rises, saying it could damage a weak UK economy. Our UK correspondent Lizzie Burden joins us now and has been speaking to Swati Dhingra. What did she have to say on this panel? Arguably one of the most interesting members of the MPC at this point.
Indeed, Tom. And we've got you covered here on Bloomberg. We've got the Hawks and the Doves. Swati Dhingra came out with her first speech since joining the Monetary Policy Committee yesterday. As you know, she's already voted to hold rates twice. She suggested that she would do the same again at the meeting coming up this month. And the reason is, she says that over-tightening risks denting the economy. The difference between her and Catherine Mann is she says the Hawks are too focused on domestically driven inflation. Take a listen to this.
Wage inflation is really a measure of the distribution of the losses from trade. It is not a measure of average losses from trade. And as a Monetary Policy Committee member, it is not our job to be able to take any kind of judgment on how the losses should be divided across the population.
So look, Swati Dhingra is the trade expert of the committee. What she says is that most of our inflation is actually imported, and she also emphasises the lag in monetary transmission. So she says the previous jumbo hikes have still yet to fully take hold, and that chimes with some of even the Hawks, formerly of the committee, who we've been speaking to. So Michael Saunders told us on Bloomberg Radio that even he would ease the pace of hikes to 25 basis points, and Andy Haldane, the former chief economist, says that he would move cautiously from here.
So the dividing lines are quite clear, though, between the Hawks and the Doves. How does that set us up for the meeting? It's 2 weeks away.
Yeah, well, it's interesting that you've had the ECB and the Fed making some hawkish noises. You saw at one point yesterday traders pricing for a peak of 5% in the key rate for the Bank of England. I put this to Swati Dhingra because it's interesting, isn't it, that the UK sits in the middle of the Venn diagram between the US's tight labour market and Europe's energy crisis. You would think, perhaps, that the UK should double down and be even more hawkish. Well, her argument is that there are differences even between France and Germany. The US is more consumer-driven, and actually, she's not as worried about a further drop in the pound as Catherine Mann told us she was. Take a listen.
So how worried as a first order should I be about the exchange rate? I think not as much as I should be about some of the other factors.
And the reason for Dhingra is because when she looks at the imports, most of them are not priced in dollars. So this goes some way to explaining how you can have such a split on the committee, members looking at the same data but reaching different conclusions. And what it means for the next meeting is it's going to come down to the men, because they're sandwiched between the external female members at the different ends of the spectrum.
Well, that's a shame, isn't it? We hope we moved on for that. But the debate is real. It's significant, of course, for the UK economy. Thank you very much indeed, Lizzie Burden. The pound, of course, maybe arguably from Swati Dhingra's perspective, a softer pound isn't that terrible when it comes to the inflation picture. Credit Suisse tumbling 5% as they withhold their annual report on the SEC questions. Stay with us. This is Bloomberg.
We have not made any decision about the March meeting. We're not going to do that until we see the additional data. The larger point, though, is that we're not on a preset path and that we will be guided by the incoming data and the evolving outlook.
It sure looks like the economy is resilient and they're going to have to raise certainly more than is priced in.
We've seen some progress, but at 5.5%, inflation remains well above the Fed's 2% target. And as a result, we've made clear we still have work to do.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Bank of America CEO Brian Moynihan speaking exclusively with Bloomberg moments ago at his firm's Global Investor Summit in Paris. This hour, we will hear from former House Speaker Paul Ryan and Bernard Mensah, President of International for Bank of America. Credit Suisse puts its annual report on hold. US regulators have some last-minute questions about previous statements. And President Biden wants to impose a 25% minimum tax on billionaires. In his budget request, the president also calls for a big jump in capital gains taxes. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And a lot happening in Paris, it seems. Kriti will bring more comments from the CEO of Bank of America a little bit later on. So that's one thing we're following. Really, it's all about yields and stocks, the way the two relate to each other. And certainly stocks not taking any comfort from what we've heard over 2 days then from the Fed chair.
Certainly risk sentiment kind of driving lower. And what's interesting here is, look, we're still waiting for that jobs report that's coming in tomorrow. That's going to be the major game changer for traders. So there isn't necessarily this massive conviction, this massive bid to go into the markets right now. And you see that across the board. Futures, for example, are lower. And you can see that by about 0.4%. This is important because we want to really see that sustainable hopping into the market. The question is, what is the market prepared for tomorrow? If we get a hot labor report, is that simply a kind of a positioning story? Or if we get a dovish labor report, do we then call that kind of one data point in a longer trend? Regardless, I think you're going to see a bigger reaction in the bond market than the stock market, because that's really where all the repricing is happening. 398 on the 10-year yield, just shy of that 4% level. Now, unchanged on the day, but really watch for that intraday volatility, because it's all about, again, that keyword positioning going into tomorrow's labor report. And by the way, the CPI report next week as well. NYMEX crude is a big story, 76 handle there. Inflation is a major theme still, even though it's coming down in the United States, coming down in Europe. It's not necessarily coming down everywhere as fast as it is in the West. And that's going to be a big part of what's driving the dollar here, weaker on the day by about 0.2%. A lot of that inflation story, though, coming not from the U.S., not from Europe, but from Asia. Overnight, seeing a little bit of mixed sentiment. The MSCI Asia Pacific Index as a net, all in all, kind of unchanged on the day. But look under the hood, and that's where you see the real divergence. The Hang Seng, for example, down about 0.6%. And this is really important because you got Chinese inflation data overnight. They said, look, inflation is coming down, but it's not coming down as fast as, again, it's coming down here in the United States and arguably in Europe as well, even though even that is starting to prove a little bit sticky. On the other hand, you have Japan really outperforming. The Nikkei stronger by about 0.6%. And in fact, the Japanese story is what's driving the dollar lower, because if you look at what's contributing to the dollar weakness today, Anna, it's all about the yen. And as you see, dollar yen trading at about 136.20, stronger for the yen by about 0.8%.
Yeah, quite a substantial move there in dollar yen. And of course, the BOJ starts its last meeting today, or has held its last meeting today under Haruhiko Kuroda. That continues tomorrow, that meeting. We get the results of that overnight US time. This is the picture for European stocks then. European equity markets trading weaker. Most sectors in Europe are in negative territory. The insurance sector, one area of brightness, but elsewhere we are seeing moves a little bit lower. Is it about the higher yield environment? We're seeing European yields ticking up once again, not at year-to-date highs perhaps, but still ticking up back towards those. And so I pulled out a German contract just to show you what we're seeing, but I could have pulled out the Italian, the French, the UK trend, all of those looking fairly similar. Here we've got the UK yield, in fact, moving a little bit higher. This is Dassault Aviation. This is up by 10.3%, one of the best performers on the Stock 600 this morning. And in fact, the full year profits coming in better than expected, and that's helping to cushion the stock, given that the CEO is still talking about supply chain issues for this defence business, but that not the key driver today, it would seem. Aviva, this is the strength in the insurance sector I was talking about. So a big player in the UK insurance market. That stock is up by 2.6%. They're returning cash to shareholders. The numbers came in the right side of investor expectation. A wide-ranging conversation with Amanda Blanc, the CEO of Aviva, if you want to look that up on the Bloomberg terminal earlier on this morning. And Deutsche Post is up by 1.2%. This is a logistics business, of course, Chrissy. And during 2020, as freight rates soared, we saw them having an incredibly strong performance, turning in a strong performance. Now things looking more normal, normalising a little bit, but they are returning more cash to shareholders, so it's managing to turn around early underperformance of the stock to see it up by just over 1%.
You use that keyword normalizing for the consumer, normalizing for the Federal Reserve. It all comes down to how do you actually navigate it from an investor standpoint, which brings us to Bank of America hosting its very first global investor summit in Paris as the French capital's finance profile rises. CEO Brian Moynihan spoke exclusively with Bloomberg in the last hour about the American economy.
The U.S. has this big, huge economy of which goes and moves along. And so, if you think about our team at Bank of America's research team, which is one of the best in the world, if not the best in the world, under Candace Browning-Platt and her leadership team, they basically have a recession predicted beginning of the third quarter this year, third, fourth, and first quarter. But it's a slight recession. It goes down 1% or 2% and then moves back up and then gets back to 1.5% growth in the latter part of next year, but still below trend growth.
Sonali Basak, our global finance correspondent, joins us now for some of the key takeaways. Sonali, he just said there, Bank of America forecasting a slight recession in perhaps this year, the back half of this year, early 2024. Walk us through what else stood out to you.
Yeah, he's been pretty sanguine about the economic forecast. And if you look at it now, a lot of his rivals are also joining him. For example, David Solomon this week has also said that he's not as negative on the economy as maybe he probably was before. He sees the possibility of a soft landing. Citigroup's Mark Mason also saying mild recession. But here's the thing, Kriti, it's really a question about rates and inflation still. This uncertainty around interest rates. I would say Brian Moynihan today had kind of mentioned this idea of a delay of what it means for the consumer. And that delay is the big unknown for the big consumer banks. Similarly, JP Morgan earlier this week talked about a cliff in the consumer at the end of the year. And with Bank of America, the good news is that he says that a lot of the rate rises, we've seen kind of the worst impacts of it, if you will. I would say that is a little bit of a different tone than his rivals. When I asked Mark Mason of Citigroup yesterday what he was concerned about, it is still the trajectory of rates and the uncertainty about the central banking path in the United States.
Yeah, and Sonali, let's stick on that. Let's go from Bank of America to Citigroup, because the CFO, Mark Mason, says his firm will adjust headcount in its investment banking division as necessary as it continues to look for ways to boost profit. And I know he spoke exclusively to you, to Sonali, just yesterday. Let's take a listen.
We've been doing lots of hiring over the past couple of years. We've really been trying to build out in areas where we've had either a competitive advantage or an area we think suggests significant growth opportunities. So we've been investing in investment banking.
So, Sonali, what stood out to you in your conversation there with Citi?
A few things, because we know that Citigroup has already cut a couple hundred people when it comes to their investment bank. And listen, Anna, this year is not shaping up like everyone thought it would. We also spoke to one of the top investment bankers at RBC yesterday, and caution is what he kept on talking about. And again, it boils down to the trajectory of rates. People thought that they would start to stabilize in the middle of this year, and guess what? They have not. And therefore, you're seeing investment banking activity be much more muted than many bankers were hoping for. I would also point to what Bank of America had said today to Francine, what Brian Moynihan had said, which is that attrition is our friend. And so you're seeing the banks pull every lever they can, because what they want to be trying to do is keep the bankers through the cycle so that they can come out on the other end very strongly. But again, this year is not shaping up to be so far what many people had hoped.
OK, Sonali, thank you very much. Bloomberg's Sonali Basak with us to talk about some of those latest things coming out of US banks. Let's get back to the European banking space. Credit Suisse has delayed publication of its annual report after last-minute questions from US regulators. The Swiss bank was due to publish the report today, but the SEC had questions about revisions Credit Suisse made to previous cash flow statements. Let us get any detail that we can get on this story with our Bloomberg finance reporter Tom Metcalf, who joins me on set here in London. Tom, good morning to you. So Credit Suisse delaying the release of its annual report. That's got to be pretty unusual. Do we know much about why?
Yeah, it's very rare for an annual report to be delayed. Look, from the reading of the statement, it does seem like more of a technicality. So basically, the SEC, very last minute, came in and said, hey, what about these cash flows in 2019, 2020? Credit Suisse have come out and said, look, our financials for 2022, they're not going to change. We just need to sort this through, dot the I's, cross the T's with the regulator. But look, anything involving accountancy and questions around that, shareholders just do not like. So I think the shares are down 2-3% today. And, you know, in the whole context of Credit Suisse, it's just another sort of unfortunate moment where, you know, they just can't seem to catch a break.
Yeah, in fact, down a little more than that now, down just over 5%. Chrissy?
Yeah, Tom, put this into some perspective for us. How unusual is it to see such an intervention from the SEC, not just on an American bank or a bank in general, but one that isn't American?
Yeah, I mean, there's definitely, these interventions do happen. What I think is rare here is it causes something like an annual report to be delayed. So Credit Suisse have already come out and discussed their full year Q4 results. But what, you know, this report is about is putting that all together, all the disclosures. And it looks like, you know, in 2019, 2020, there's very complicated restructuring in terms of the accountancy behind it. Looks like it's sort of flagged some alarm bells at the SEC.
Certainly something that is, as you said, means that Credit Suisse just can't catch a break. Bloomberg's Tom Metcalf, thank you as always for walking us through that story. I want to go from the Zurich/Washington to the politics of Washington. President Biden will target billionaires and rich investors in the budget request he unveils today. Billionaires would be hit with a 25% minimum tax, and income taxes on corporations and wealthy Americans would be raised. And the current Bloomberg economics reporter is keeping his eye on Washington for us. And these tax measures, how likely is it that they actually come through fruition?
Well, they're very unlikely given the Republican control of Congress. But like you mentioned, this is all about Biden's economic and political agenda. He's trying to roll back some of the breaks during the Trump administration years. You mentioned there almost a doubling of capital gains tax in the proposals. There's also that big tax hike on billionaires and the richest in the US. Of course, that's all fitting into the broader Biden narrative. He has tried to get measures like this through before, but of course he hasn't had the votes in the past. What it does also speak to, though, is a little bit about the deficit debate that will, of course, be coming up later this year with the threat of the debt ceiling and the government shutdown and everything else. So this one speaks to both the economics of the Biden administration and, of course, the politics that will be staring down the line when those debates hot up on the debt ceiling later this year.
Yeah, give us a bit more then, Enda, on how this fits into that broader picture. How do these tax measures fit into Biden's economic agenda?
Well, of course, on paper, it's all about wealth redistribution. It's all about tackling inequality. It's a way of targeting the deficit. As I said to you before, the Build It Back Better campaign was a big part of the Biden administration's push, but, you know, they had to make a lot of compromise on that too. So it fits into Biden's broader outlook. And, of course, chatter of US election campaign will get off the ground again as this year gets going. But as I say, the reality of this dictates that the Republicans won't allow it to go through. The Speaker of the House, Kevin McCarthy, has already been out raising questions about it. So it's more a case of flag waving by the Biden administration rather than achieving anything substantial. But it does speak to where we will be in a few months from now, which will be a big clash on the debt ceiling and the deficit story in the US.
Certainly comments that are perhaps adding to the lower risk sentiment we're seeing in markets today. Bloomberg's Enda Current, we thank you as always for walking us through the details. I want to get to some of the pre-market movers that we are seeing early in the session. Start off with the major one, Silvergate. Shorts amassing $780 million in a payday as the bank continues to spiral. We were talking about Credit Suisse, how they can't catch a break. Silvergate can't either. It's already down about 44% in the pre-market. Perhaps not as bad as it was earlier. It was down at 50% at one point. Now, perhaps pairing some of those losses, but still 44% lower on the day, Anna. Nothing to scoff at there. I want to stick with the banking story and go to Silicon Valley Bank, or otherwise known as SVP, falling on a $1.25 billion share offering. They're announcing that $21 billion security sale, essentially it having a dilutive effect on the shares specifically. So you can see those shares down about 27% in the pre-market, which brings us then to one story that is not at all related to banking, crypto, or technology. Etsy is the one catching my eye, this time prompted by an analyst downgrade, cut to an underperform over at Jefferies, a price target of $85 a share, really trading at 107 right now, nevertheless pushing those shares down lower by about 5%, Anna.
Chrissy, we'll focus on those in the pre-market, but also coming up on the program then, more from the Bank of America Global Investor Summit in Paris. We already heard from the CEO of Bank of America. We will be back in Paris shortly. We'll be speaking with the former House Speaker, Paul Ryan, and Bernard Mensah, President of International for Bank of America. And a non-recession recession. Apollo CEO Mark Rowan thinks the current distress cycle might not be that bad.
The excesses in 2007 were funded with leverage. The excesses in 2021 were funded with equity. So I believe that while we will have some amount of distress, I don't think the distress cycle will be anything like what we saw in 2008. And I think most of the pain is actually going to be borne by equity.
We're still very bullish on India. And there's so many companies out there that have excellent corporate governance. So I have no worry about Adani and how it's affecting the Indian market.
Mark Mobius and Mobius Capital Partners speaking with Bloomberg earlier, saying, look, he is still bullish on India. Joining us now with a little bit more perspective, Sergey Durgachev, Union Investment Senior Portfolio Manager and Head of EM Corporate Debt. A pleasure to have you on the show. Sergey, let's start there. We're seeing kind of this dollar weakness story pick up in the markets. It was supposed to make EM the no-brainer trade. To what extent has the saga with Gautam Adani's big, massive company and enterprises, his empire, really cast a shadow on that trade?
Yeah, thank you very much, Kuti. First of all, the situation with Adani, we view it as an idiosyncratic event. Union Investment has not been engaged in Adani. Actually, we are not engaged in this name since early last year. And we think that this situation casts actually the importance of getting more thorough analysis of ESG risks, which are becoming actually more prominent also in assessing the creditworthiness of emerging markets corporates and emerging market sovereigns.
Well, when we're looking at the emerging market story, it does feel like it's been really at the whim of the dollar. But as we look at a Federal Reserve that is perhaps still looking to be even more hawkish, higher for longer seems to be the consensus here stateside, does that then make EM suddenly far less attractive than it was, say, 6 weeks ago?
No, because on one hand side, we have seen a superb start of the year. I mean, the total return was for EM hard currency sovereigns about 5%, for emerging markets corporates about 3%. Now we actually about 0.6 and about 1.4% respectively. And to a large degree, this has been actually erased by actually the expectations that we had basically from November last year from the market, that actually the inflation path will be actually gradually reduced. And actually we've seen also in the markets that due to psychologically driven also attention of investors towards each individual data print, that some small deviations basically can cause huge swings in volatility. And actually regarding emerging markets hard currency, but also to local currency in some ways as well, we are still, I would say in quotation marks, also like hostage to the situation regarding developed market growth and central bank policy, because this is all the primary performance driver so far at the moment for emerging market assets.
Sergey, can I ask you, we started the conversation talking about India there. Chrissy was asking you about that. How do you make sure then that you stay on the right side of trades with the opportunities that the sort of economic rise of India represents during the COVID boom, given, during the COVID period, given the way that China treated COVID, given the geopolitical tensions between China and the West? This was seen as a period where India would benefit. How do you make sure you pick the right opportunities in a place like India, given what we've seen with Adani?
Yeah, we like India, and I'm speaking more about the hard currency, especially corporate and banking debt side, because one of the advantages of India, actually there are two aspects. One is the supply out of Indian corporate and banking space has been actually very low. We haven't seen that many deals last year, and even this year we have only the HDFC with 3-year dollar bond coming to the market. So pipeline is very thin, which is a positive technical. And the second aspect is many things have changed for emerging markets since Russia-Ukraine war started last year. And because some countries have actually also benefited as a gateway between East and the West in this new geopolitical transformation, and India is certainly one of the beneficiaries, being very crucial geopolitically, both to the West, but also to Russia and China.
Yeah, interesting role that India plays there. You mentioned issuance there in the context of the India story. What about the broader issuance picture when it comes to emerging markets? I know that you've told us that you're seeing actually quite slow new issuance pipeline in sovereigns and in corporates, perhaps. What kind of a clue is that for investors?
Basically, we see it as a positive signal, and I can explain why. Because for sovereigns, we have around about $70 billion issued that year, but a lot is actually basically those backlog coming from difficult 2022. So basically, we cannot claim that it's a very huge amount of issuance. For corporates, it's even less so. So we are about $62 billion of emerging markets corporate issuance. The positive thing is we are realizing that in this current environment, not every issuer can actually issue debt. So many issuers who actually used the slow interest rate environment in 2017, 2018, like for example, many companies from China, in particular Chinese high yield companies, they are at the moment, they cannot actually, or at very high prices can actually access the market. So we expect that the issuance picture will be actually that we will see not a huge supply, so there will be more selective issuance. And what we are also observing that some new countries are actually getting more traction, that we'll see potentially also more deals from issuers from newer countries, like, for example, Saudi Arabia, which is a good example where issuance is picking up also on the corporate debt side, where the country and also the capital markets are opening up.
Well, Sergey, you mentioned the corporate debt side on the EM space, but talk to us a little bit about simply the kind of regions where you're starting to see a lot more attractive opportunities, specifically on the corporates that are issuing.
Yeah, we are very confident on one hand side on the GCC, especially on Qatar and also on UAE-based issuers, because both countries, they benefited a lot from this geopolitical transformation. They are benefiting also from energy transformation, with both countries also playing a very important role in also energy deliveries towards the West as a substitution for Russia. And basically also the fundamental picture of issuers in Qatar as well as in UAE is very solid. In Asia, we are very big fans of Indonesian corporate space, and in LATAM, we like Mexican corporates. And in CEMEA, our favorite spot is Kazakh corporate.
Sergey Dergachev, you heard it here first, folks. His picks of the EM corporate space of Union Investment. We thank you, as always, for your time and for your insight. Now, keeping up to date with news from around the world, here's the first word. Bloomberg's learned that Northwestern University professor Janice Eberly is a front-runner to become the vice chair of the Federal Reserve. Eberly was chief economist at the Treasury Department under President Obama. She would succeed Lael Brainerd, who was picked as President Biden's top economic aide. In Israel, tens of thousands of people headed for protests over the government's plan to cut the power of the Supreme Court. There may be demonstrations in 20 cities. Protesters are calling it a day of resistance to dictatorship. Prime Minister Benjamin Netanyahu and his allies say they're trying to rein in a court that has overstepped his authority. JP Morgan is blaming former executive Jes Staley for the bank's ties with disgraced financier Jeffrey Epstein, and it's demanding that Staley return all of his compensation for an 8-year period, more than $80 million. Just weeks ago, JP Morgan defended Staley against accusations he knew about Epstein's sex crimes. Staley has denied knowing about Epstein's abuse. Investing in luxury watches the last 5 years would have brought you a better return than if you had put the money into the S&P 500. That's according to a new report from the Boston Consulting Group. Prices for a basket of pre-owned watches such as Rolex and Patek Philippe rose by an average of 20%. It was more than twice the S&P's pace. People looking for apartments in Manhattan have seen little relief this winter from near record rents. The median rent on newly signed leases last month was $4,095, according to appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. That's down just $2 from January and $55 from last summer's all-time high. And Anna, that's the first word.
Okay, yes. I mean, maybe if you bought a watch instead of the S&P 500 last year, you can afford to put that down, get you some way to getting one of those apartments. Kriti, that was the first word. Thank you very much for that. Now, coming up live from the Bank of America Global Investor Summit in Paris. We've been there all morning, hearing from a lot of key voices from both Bank of America and the wider political and economic space in France. Well, we'll broaden the scope of the guests now. We'll be speaking with the former House Speaker in the United States, of course, Paul Ryan. He'll be joining the team on the ground in Paris at that Bank of America conference. That's coming to us shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Bank of America CEO Brian Moynihan has been speaking exclusively with Bloomberg at his firm's Global Investor Summit in Paris. He talked Brexit, recession, headcount and more. Up next, we'll hear from the former US House Speaker Paul Ryan and Bernard Mensah, President of International for Bank of America. Credit Suisse puts its annual report on hold. US regulators have some last-minute questions about previous statements. And President Biden wants to impose a 25% minimum tax on US billionaires. In his budget request, the president also calls for a big jump in capital gains taxes. I'm Anna Edwards in London with Kriti Gupta in New York. Matt Miller is off today. And some of those political headlines around tax, Kriti, you might expect those to put some downward pressure on stocks. We're seeing downward pressure on stocks, but possibly not for that reason, because maybe the Biden administration's plans will have a difficult path through Capitol Hill.
That and, of course, positioning ahead of the U.S. jobs report, all really leading to this idea of poor risk sentiment in the United States. You can just see that in the stock market. You see it in the bond market as well. Arguably, even the currency market, Anna, the weakness across the board seems to be the story. Futures are down about 0.3%. But check out the bond market. We're getting closer and closer, bouncing up against that 4% level on the 10-year yield, 3.99 on that note. But check out as well the inflationary story. They love to look at oil for this reason. Are we starting to see, even with this narrative of inflation kind of coming down, a little bit more kind of progress in the CPI report, not just here in the States, but even around the world? China, for example, inflation easing in that part of the world as well. Nevertheless, NYMEX crude still positive on the day, only marginally, but trading with a 76 handle. So not necessarily seeing as much momentum pulled out of the commodity space as formerly thought. The Bloomberg Dollar Index is crucial as well, probably following the lead of what you're seeing in the kind of bond space as well. The dollar weaker by about 0.2%. A lot of that coming from Japan and the strength you're seeing in the Japanese yen. And I want to quickly hit some pre-market movers here because there are some big ones and they are all a doozy. Silvergate is the big one, down about 45% in the pre-market after shorts get almost a $780 million payday. The bank really can't catch a break as we start to see more and more outflows coming, really a kind of legacy of a lot of the chaos coming in the crypto space. SVB Financial is the other one that I really want to talk about. Down about 30% in the pre-market. This comes after a $1.25 billion share offering. They announced $21 billion worth of a security sale, kind of having a dilutive effect, but simply the margin of that issuance. And lastly, some analyst moving Etsy shares down about 5%, cut to underperform over at Jefferies, a price target of $85 a share, of course, trading right now at 107, Anna.
Kriti, let's have a look at the European market then, and we're down 0.6%, so poor risk sentiment to Kriti's point there, here in Europe as well as over in the US ahead of that jobs report. UK two-year yields just symptomatic of what we're seeing across Europe, those yields ticking higher once again as we continue to question how high this rate hiking cycle will go. What will the terminal rates be in various parts of the world, and how long, crucially, will we stay there? Credit Suisse down by 5%, another 5% lower for this business, which of course has been hit by waves of scandals over recent years and big restructuring at the business. Well, now regulators in the US have some questions that has meant a delay in the issuing of their annual report. That seems pretty rare, and as a result, the stock tax lower once more. Aviva in the insurance space in London. This is one of the only sectors, actually, Kriti, that's doing pretty well today. Insurance lifted by Aviva, the company returning cash to shareholders and beating estimates.
A lot to keep an eye on the corporate space, on the kind of macro space as well, and certainly in the political space, which brings me, let's go now to Paris, where the Bank of America Global Investor Summit is underway. Bloomberg's Francine Lacqua is there with former House Speaker Paul Ryan. Over to you, Francine.
Thank you so much, Kriti. Yes, I'm delighted to be joined by Paul Ryan. Thank you so much for joining us. We have 1,000,001 questions. I know you just also did a conference downstairs. We're here at the Bank of America conference. The debt limit, should the markets worry about this, Mr. Ryan?
I don't think the markets should worry too much. We will pay our bonds, we will pay our bills, but it's going to be a bumpy ride until that moment happens. It's not inconceivable to me that we go a little bit past the X date, because I think Treasury can prioritize. But once you get into prioritizing, the politics gets really ugly.
Yeah, but why go past that date if there's nervousness in the market and you just don't understand why the U.S. is in the state?
That is just how the politics of these things typically work. I've been involved in a number of these deals. Yeah. It is not rare to have fiscal reforms coupled with a debt limit increase. I don't think that's asking too much, frankly, by House Republicans. I was part of the BCA in 2011, and I was part of an agreement in 2013 that fixed this. So we have a debt problem. We have a debt crisis coming. It's a good idea to get something to get under control. And it's not going to be big entitlement reforms like Medicare and Social Security, but maybe they can get some fiscal caps, spending caps in place. But it's clear the Biden administration doesn't want to do that, so I think you're going to have a little bit of brinksmanship here. But at the end of the day, our bonds are going to be paid.
Okay, but is it right to bring it until the very end?
Probably. That's usually how these things go.
I've
done 2 or 3 of these deals. It was always like the day of or the day before.
Right.
It would surprise me if they saw this much earlier than that.
Okay.
But at the end of the day, we're going to make good on our bonds. Our full faith and credit will be maintained and intact.
So the message to the markets is stay cool,
even
if you're going to see volatility.
We're going to pay our bonds. It may be a little bumpy. Maybe just don't watch TV for a day or two.
Well, except for Bloomberg, definitely
except
watch
for,
Bloomberg.
Yeah, sorry.
You don't have to watch anything else. McCarthy's strategy on this, how do you see that developing in the coming months?
Well, I mean, his members, which I used to manage the same conference, want to see a budget advance that actually gets our fiscal house in order. So I'm happy that we have this revived concern about our fiscal problems. But you're not going to get a giant package through something like this, a debt limit increase. So the question is, can you get some pretty good incremental fiscal reforms in place, like, say, spending caps or some kind of financial mechanism to help get our debt going in the right direction?
And you think
we'll
we'll
see
get
what
that?
that looks like. I think it's possible. And the reason I think it's possible is because that's what we've done before in the past. So we'll see what happens then. But at the end of the day, we're going to really have to get serious about our debt crisis. It's every modern country has this problem. And we can't keep piling on this kind of a debt because we're the world's reserve currency. We're not acting like a reserve currency, frankly.
Or is it playing with fire, doing it at this time of market volatility because inflation is up and actually the Fed is raising rates quite aggressively?
It's suboptimal, I would say, but it is what it is. This always happens, especially when you have divided government. So hopefully cool heads can prevail, and hopefully the administration will agree to some kind of fiscal reforms that will help us put our debt in the right trajectory.
Is monetary policy on the right trajectory right now?
I don't think they have a choice. Yeah, I think January's numbers were pretty clear. It's going to be a lot harder to get inflation from 5 to 2 than it was from 8 to 5. And the Fed doesn't have a choice. What worries me is the fiscal policies that we could put in place, supply-side fiscal policies, make tax cuts permanent, increase labor market participation through immigration reforms, things like that. Those aren't going to happen. So fiscal policy is not going to be improved from a supply side standpoint. So it's really all on the Fed. And my guess is you probably won't get out of this without a recession. Get out of this getting to 2% inflation. It's going to take a long time, longer than people thought and hoped. And it's going to be a lot harder for the Fed to get to 2% than it was from 8 to 5.
So you think, is there a possibility that they have to crush the economy to get to 2%?
I mean, I don't like to use the word crush, but it would surprise me that we could get out of this, get to 2% without a recession. And the Fed cannot back off that 2% target. If they do, they'll lose their credibility. They know this. So that's why I think their terminal rate's probably going to be a little higher today than what we thought it was, say, a month or two ago.
But recession with a lot of job losses, or what kind
well,
of
let's
recession?
hope not. I mean, it's been amazing resilient, the job economy. But if unemployment gets to something with a 5 handle, I think the Fed's going to have a little harder time getting consensus. So I think it's in Jay Powell's interest to get as many rate increases as he can right now. I frankly think they should have stayed with 50 basis point raises and not gone to 25. I think that head faked the market. It sort of pump faked the market. Hopefully they'll go back to 50 because get it now as fast as you can. Get the rate increases now that you have a consensus on the Fed. Because if we start seeing unemployment really starting to creep up past 4%, then I think it's going to be really dangerous and difficult.
I guess the danger is that there's a monetary policy lag.
There is.
And then that means a mistake, and then they have to.
Yeah, then they overshoot. The Fed's been overshooting. That's the story of the Fed. But I don't think the Fed really had a good thesis on how inflation works. They had the great moderation baked into their models. So I think the Fed was a little too late. They kept rates too low. They had too many asset purchases. Now they're making up for that. But it's really clear it is stubborn. And with decoupling happening, with delinking our economies with China to some degree and deglobalization happening to some degree, that stuff's all inflationary. So there's structural inflation baked into the cake, which means it's going to be harder, like I said, for the Fed to get inflation closer to 2% than getting it from 8 to 5 like they've already done.
How would you describe the mood in Washington, D.C. right now? From the outside, it seems like, I mean, we're not talking about not getting along. This is, even more than that. Is there anything that you can both parties can agree on to get done in the next 2 years?
I wish we had a better political climate. Our politics are pretty unserious. I just put out a book at the American Enterprise Institute showing how to get the debt under control, to preserve the dollar as the reserve currency. We're not doing those things because we have unserious politics. Yep. The one thing I would say to that, though, is we are forging a bipartisan consensus on how to deal with China. I have a lot of confidence in party leaders in Congress right now, in this new committee chaired by a guy named Mike Gallagher, that there will be a bipartisan consensus on how to deal with China. So that is something that I think you'll see us working well together. There are going to be some bipartisan things, but it's mostly going to be revolving around our foreign policy. Our China policy and our Ukraine policy, I think, will still be bipartisan.
Okay, what will happen in Ukraine? More weapons, more money?
I think more weapons, more money. There's still a lot of support for that.
Both sides?
Both sides.
Is there a limit to that as we get into the presidential election?
there's a limit to how much our defense industrial base can produce,
right,
and there's a limit to how much we can get to the field on time to the Ukrainians. So, yes, there's a limit based on capacity. But I don't think there's a limit to our support, broad Republican support, broad Democrat support for supporting our friends in Ukraine, to standing up against Russia. And there's obviously a lot of consensus on how to deal with China.
Who do you think will be the Republican candidate?
I think it's going to be somebody not named Donald Trump. We know that we lose with Trump. We lost the House in 2018. We lost the White House and the Senate in 2020. We lost the Senate again in 2022. We didn't win nearly as many seats in the House as we should have in 2022, largely because of Trump. Our voters more or less know this. So I think the fact that we want to win, we know we need to nominate somebody not named Trump, and if we do, I think we'll win the White House.
So who, if not Trump?
It's too early to say. I just don't know the answer to that question.
There's this big investigation, and of course the reaction from News Corp and Fox on how they dealt with allegations of the election. What's your take on that?
Donald Trump lost the election. It's really clear.
But Fox should have.
Well, there's a lawsuit. I don't want to get into pending lawsuit issues, but there are some opinion hosts that made their opinions, and there are people who, on behalf of the President of the United States, made claims. Those are newsworthy claims. They were faulty claims. But when the President of the United States has his lawyers saying things, that is a newsworthy event. Those claims were false. Donald Trump did not win the election, and he spread conspiracy theories to the contrary to that. And we all know that.
All right. Thank you so much for your time, Paul Ryan, there. With that, I'm going to send it back to New York. And, of course, we'll have plenty more interviews from Paris throughout the day.
Yeah, absolutely. We'll be back with Francine shortly. Thanks to Bloomberg's Francine Lacqua in Paris. We'll get back to Francine after a short break. She'll be speaking with Bernard Mensah, President of International for Bank of America. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Ireland's Finance Minister, Michael McGrath. That's at 1:30 p.m. New York time. This is Bloomberg.
Well, that makes the Fed's job tougher, and that's the dialogue you have about how you can slow it down. But it all comes back to unemployment. Unemployment's low. Wage increases are still pretty strong. And you don't see that. New claims for unemployment, we'll see what happens this week. But each week it's hovering at a level. It's very low, and there's some seasonality debate, but it's still very low if you thought you were really in a recessionary environment.
That was the Bank of America CEO Brian Moynihan speaking exclusively to Bloomberg's Francine Lacqua at the Global Investor Summit in Paris. Francine is back with us with another interview with Bank of America. Francine?
Yeah, thank you so much, Anna. We are delighted also to be joined by the president of Bank of America International. He's Bernard Mensah. Thank you so much for joining us, Bernie. First of all, congratulations on a wonderful summit. I know many people haven't caught up in a long time. We also spoke to Paul Ryan, the former House Speaker. So we're looking at politics. We're looking at, of course, Wall Street and banking. How's it feeling at Bank of America internationally?
It's feeling good. Thanks for having me on. There's a lot going on out there, and so I think it plays to our strengths because we can really work with clients across the globe and help them in a period where I think there's a lot of transition going on. So we're engaged, and part of the reason we had everybody come here was to just level set, get everybody up from their day-to-day, get a lay of the land, and then get back to their desks, I guess.
So is there appetite from clients to try and do more, or are they sitting on the sidelines in terms of deals and in terms of expansion just because they want to understand how inflation pans out?
I'm finding clients super engaged. I think that they're thinking through. There's just so much that has happened, apart from the COVID and the energy transition and capital flows, the macro issues around what central banks are going to do, not just with rates, but just with the absolute levels of their balance sheets. And so all of those things mean that I see clients super engaged, thinking, planning, and just trying to position themselves for just transitions in so many of these sectors, whether it's tech or pharma or capital flows. So that's good.
So what does it mean for expansion for Bank of America? If you want to be closer to your clients, are you targeting industries or actually regions?
I'd say across the piece. So in Europe, where we are now, in a way, our investment in Paris has meant that we're that bit closer to our clients. So I think it's terrific, the feedback we're getting in terms of what they need, our ability to deploy our resources and help them think through broadly is terrific. And then when you go internationally, as I do, I think those cross-border flows are terrific. There's a lot going on in the Middle East, places like Saudi, and as you go further across in Asia, you have the IRA and the Inflation Reduction Act, which means that given that we have our U.S. base, we can really engage, in that dialogue. So for us, a lot of it is really delivering the incredible resources we have and the investments that we've made as a firm to our clients. From where I sit, I just see the breadth of that, and the challenge really is getting to them as quickly and as best as possible.
So is also money flowing to where it should be in terms of, if not fundraising, certainly clients wanting to access capital. Is that working as it should? Or again, are there questions marks because of this, I guess, change in markets because of flying interest rates?
So that's really interesting. I think that the money flows, and it's something that maybe from my background in fixed income, I've been thinking through. I think that's super interesting. Now, the public markets haven't done so much. Private markets have slowed down a little bit on the back of that, but there's still a huge amount of excess savings out there. Where those savings are, so I'll give you a couple of trends. One is, Germany is running a deficit for the first time, right? A current account deficit. I think last year was the first time, maybe this year. Where are those deficits? So Europe, as a perennial sort of accumulator of savings and capital, hasn't done that in the last period. So it's importing capital. It might be repatriating some of its capital. Some of that is going to the Middle East, and a lot of that is to do with the energy shock. So that's one interesting aspect. And then if you take central bank balance sheets, the ECB has started to reduce its, the balance sheet increase was huge because of COVID, and some of that dwarfed actually all of the QE. So if you take the EU, which might bring its balance sheet down by about $1 trillion by the end of maybe next year, that's, 15% of EU GDP. So those flows are really interesting, and I think our clients will have to, and asset managers and investors need to have that backdrop as they manage, their investment decisions.
Are we underestimating actually the impact that the war in Ukraine has longer term for the energy complex? And therefore, we mentioned the Inflation Reduction Act, but actually the way our economies work going forward.
I'm not sure if we're underestimating. It's a good point. I think when it happened, the immediate issue was, would we get through the winter? And I think Europe did a terrific thing there. I think broadly speaking, then the question is, what's the energy mix in Europe? And what's the cost of energy for a European economy that is quite energy intensive? So I think a lot of people are thinking through that. When I talk to CEOs and some of the government officials, they absolutely are thinking through that. And I wouldn't say wargaming, but strategizing over the next period of time around that. And other energy provinces are having to sort of think of whether it's the US or the Middle East or elsewhere. But it's also accelerating the ESG dialogue, because I think Europe in particular is thinking that over the next period of time, without Russian oil and having to think through other things, actually there's even more reason for transitioning to clean energy.
Do you have a lot of your international clients actually wanting to put more money in the US because of the Inflation Reduction Act, instead of either in their home countries or elsewhere in the world?
That's a good question. I certainly think that the Inflation Reduction Act has, for a lot of European clients I've seen, has really made them think about that as a possibility or an alternative. But I'd also say that it's within Europe as well, and elsewhere in the world, has made people think through. Europe has a huge amount of money or resources to put to incentives and tax breaks. So then you have some of the conversations around the effectiveness of how quickly you make things happen, how quickly you get your approvals through, and the framework for investment decisions to be made. But certainly it's started an interesting dialogue in C-suites, certainly.
Bernie, thank you so much for joining us today. That is Bernard Mensah, of course, the Bank of America President International. So with that, I'm going to hand it back to you in the studio, and then we'll have plenty more interviews from here throughout the day.
Thanks very much, Francine. Bloomberg's Francine Lacqua in Paris, of course. Coming up next, we'll run you through the key events that we're watching in your trading diary in the day ahead. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Matt Miller is off today. Let's take a look at what's ahead in the trading session at 8:30 a.m. Eastern. We're going to get initial jobless claims data, some sort of precursor perhaps to the jobs report tomorrow at 10 a.m. Norfolk Southern Railway CEO Alan Shaw due to testify in front of a Senate panel about the derailment of one of the company's trains in East Palestine, Ohio. A very political and controversial move here in the States. Also later today, President Biden will unveil his budget proposal. Officials say Biden's plan will show a commitment to cutting the deficit. Anna, it's that Biden story that's going to ruffle a lot of feathers on Wall Street, especially the folks that make the big bucks.
Yeah, absolutely. Interesting to think about what it means politically, but also how likely it is, given the politics on Capitol Hill, of course. Another story that caught my eye, Chrissy, and you won't be surprised to hear that this has proven to be a very popular story on the Bloomberg terminal this morning. Rookie traders in Sydney, in Australia, some of them taking home $400,000 a year. And this is straight out of college, straight out of university. This isn't just any old job, though. This is tech-driven trading, and the city turning itself into a bit of a hub for this. Businesses like Citadel, IMC, Optiva. I mean, on a cold and foggy March, are we in March day here in London, Chrissy? This is the kind of story that really makes you question your life choices.
It really does. And I may imagine a lot of folks in New York are reading the story and thinking, I want to move to Sydney as well, simply because you can have that same job here in the States and not make that kind of dough. $100,000 to $120,000 is the base salary for the same role here in New York. And a lot of folks are saying, look, it's the Australian college system that just breeds really strong candidates for the trading floor.
It does seem to have turned itself into a bit of a hub. Really interesting story by our colleague Patrick Winters then. Dig it out on the Bloomberg terminal. Interesting to find a section of finance that is still recruiting. They are still recruiting in this part of the world and this part of finance, not the message we're hearing from lots of other big players in banking, of course, which is more about job cuts. So that's the focus today. The focus tomorrow, of course, Chrissy, will be on jobs of a different variety, the jobs report.
It absolutely will, and it's going to be fascinating when we hear what does a hot labor market look like when it comes to the markets, or is it all priced in?
Yeah, absolutely. After that JOLTS report of yesterday. That is it for the early edition. Surveillance is ahead with Tom, John and Lisa. They'll be speaking to Christian Muller-Glissman of Goldman Sachs, among others. This is Bloomberg.